Hi, and welcome along to this next session. My name is Katie Martin. I'm the markets editor in a slightly snowy, slightly soggy London for the Financial Times. And we're here to talk about the case for investing in Japan. I'm delighted to be speaking to another Katie, that rarest of things. Katie Koch is the co-head of the fundamental equities business at Goldman Sachs Asset Management. Katie, thank you for joining us.
It's my pleasure. Excited to be here.
So we're talking about the case for investing in Japan, and it's funny. Last year, after Warren Buffett bought stakes in a range of Japanese brokerages, I was speaking to a CIO over here in London precisely about this issue. Is it time to have another look at Japan? And he was saying on his very first day in the job 20 years ago, someone gave him some solid advice, which was never wear a pink shirt to work and never invest in Japan. And it feels like whatever your thoughts about pink shirts might be, that really
Yeah.
is changing now. I mean,
Mhm.
for you, this has obviously been a part of your business for a long time. Tell us about how you approach Japan as GSAM.
Yeah. Sure. So first of all, on pink shirts, I'm all about a pink shirt for a man or a woman. Love them both. I actually agree with none of that advice. But we do think Japan is quite a good place to be invested. But maybe I'll start with just a couple of comments as to why people are nervous about it. And let's talk about
Yeah.
some of the bad things, because there actually are a lot of things to be concerned about. So on the macro side, just to hit them quickly, we have one of the highest debt to GDP burdens of any country really in the world, developed or emerging. We also have a very challenging demographic backdrop with a quarter of the population 60 or over. That's going to a third. And as people know, growth is just a breakdown of people, capital, and total factor productivity. And so if the population is large but actually aging, it's not good for growth. So you have a lot of debt, a growth profile that doesn't look great, very tough to get inflation going. That's on the macro side. And then on the equity market side, you still have a good chunk of the TOPIX, the broad equity market, that's invested in sectors like banks, old transport companies, some old materials companies, some old auto companies. So actually pretty challenged corporates. So those would be a lot of reasons to be quite nervous about investing in Japan. I know the title of this is to try and get people excited about it, and I will, but we should acknowledge some of the challenges. On the
Yeah.
flip side, and we'll spend more time on this and go into more detail, I just want to make three brief comments. The first is that the macro is challenged, but there are some things happening to help improve. So, for example, we can go into this in more detail. But since Abe was originally elected and his successor is carrying on in this way, Japan went from having the worst female labor force participation rate in the OECD to actually the best, and that is really countering some of the demographic challenges and contributing more to growth, which is good. The other comment I would make, because I talked about equity market composition, is that yes, you don't want to own the TOPIX. And it's not just us. There's actually a lot of great managers in Japan. You want to be in active management because there's a good 30 to 40% of this index that you don't want to own, but there's another 60% that is actually tied to secular winners, which we can spend more time on, that I think are really attractive to consider. And then the third point and final point is just around corporate governance improvements. So you are actually seeing positive return on equity improvements and more upside for return on equity just through running these companies more efficiently. And we should dive into what they're actually doing there. And so we think about half the TOPIX has made that journey, but there's another half that's actually focused on some improvements like independent board of directors, executive compensation, unwinding cross shareholdings, which is unlocking a lot of profitability even in the absence of upside. And I know I said three things, but I'm going to end with one comment, which is valuations, which I think people should really care a lot
Yeah.
about, because this market is offering selectively some interesting growth opportunities at some of the cheapest valuations in the world.
So there's a lot to unpack there, and I would encourage people
Yeah,
in the audience to use the little chat box to ask your own questions. We'll get through as many as you can. But to go back to some of the points you were raising there, as you say, just
yeah,
investing on an index basis in Japan doesn't make a lot of sense. What does
right.
make a lot of sense?
Yeah. So you want to But probably, and again, always consider your source, which Katie, I know is something you're an expert at. I'm biased, so I want to recognize my biases that I do run an actively managed business. But the way that we invest in it, or has been very successful for us, is we run highly selective portfolios. Because again, you're investing in a market where there's actually a lot of broken companies that you need to sift through. So we, really recommend highly concentrated portfolios. Those portfolios should be invested in companies that are tied to the secular growth opportunities that exist there. And so let me just name a couple of themes that we think are interesting. Electronic vehicles. But instead of having to pay for the valuation one might have to pay for the Teslas of the world, you can buy companies making the component parts to electronic and autonomous vehicles. They're going to benefit from the same secular growth story, but again, accessed at much cheaper valuations. A lot of the companies making component parts for the Internet of Things would exist there. We would say robotics, because their neighbor obviously is China. Labor costs are going up. They're going to have to get more efficient on the factory floor in China as well as all over the world. And Japan is a leader in robotic and robotic component production. Emerging market consumer, obviously facing some headwinds at the immediate moment with COVID, but there are some great plays there as Japan becomes more and more of a tourist destination. And the last category I would talk about, which we're very excited about globally over the next 10 years, is the future of healthcare and the way technology is coming into the healthcare sector and driving a lot of disruption. Now, those are not the majority of companies listed in the topics, but they exist and you can hunt for them and build a highly selective portfolio focused on them. So just I would say, three things: get those secular growth companies, point one. Point two, make sure that they're on this corporate governance journey of improvement, and many of them are. And then the third point is, keeping an eye on valuation. So you can build a portfolio really that still has better or equal growth opportunities as the US at a substantial discount.
It's an interesting point. And you talk about a highly selective portfolio. How many names do you think is optimal, at least for you?
For us, 30 is what we are focused on. So, a range of 25 to 35 names. And I would also just encourage people looking at this space, if you do buy into a highly selective portfolio, expect a lot of volatility, right? You're building something very different from the index. It's going to perform different. It's a hugely alpha, there's a possibility of harvesting, 1,000 basis points plus of outperformance. But my advice would be to be committed for the long term, because it is going to perform very different from the index. You're going to pick up a little bit of volatility over time. So commit for the long term. But there's not just a great beta story here. Again, I want to emphasize there's a tremendous alpha story as well.
And it's funny because generally when people talk about that sort of alpha strategy, it is largely in relation to US markets. There's obviously some very shiny names. You mentioned Tesla, for example. But what would you say kind of characterizes the Japanese market? Does it feel like a growth play, or does it feel like a kind of a value play, or does it feel like it's its own thing entirely?
Yeah, I mean, the index itself is definitely more skewed value than the rest of the world. And just when you look at Japan as an equity market post the bubble, a lot of people bought it as a value market, but also as a mean reverting market. And the reason for that, of course, is the currency. That what would happen is that when the yen cheapened, the export companies, which still did and to some extent still dominate the index, would obviously rally on the back of the cheap currency, and you would get this lift in equity markets. Now, if you were a foreign buyer of that and you're measuring your return in euros or sterling, for example, that was kind of a wash trade, because you made some money on the equity, but you lost it on the FX because your day-to-day liabilities were local currency. And so that was frustrating for people, understandably. I would say, to answer your question, I think it's its own market. I think the index, again, is different from the portfolio you can build. The index still has some mean reversion and still is more value-oriented than rest of world. But selectively, you can build a portfolio that is more secularly geared and a more growth-oriented portfolio versus rest of the world. And again, I'm bringing my active overlay to it, but these are the types of companies that, we're invested in, and we want them to be compounders, so to own them over time. And I think, I've said it before, but I want to emphasize again, it's very tough to get exposure to these types of secular growth themes that are really going to change the world over the next 10 years at these valuations. It's actually one of the only places in the world where you can access the quality of corporate governance. Again, you have to be selective around that, the secular growth orientation at these types of valuations. And so to answer your question clearly, I would say the index is still somewhat value and mean reverting, but the opportunity to build selective portfolios can get you into that secular growth space.
And you've spoken about corporate governance improvements, and you've spoken about getting women into the workforce. How big of a driver on corporate returns is that?
Yeah, so the ROE of Japan writ large still lags its developed market peers. So let's just call it Europe and the U.S. And in fact, people should be aware that they actually had a fall in profitability during COVID, so they took a slight step back in 2020. But we actually think that corporate governance returns are going to take it from like the 5 or 6 ROE, which is lagging developed world at 8 to 10, to actually still have the ability to be up by 50, 75% over the next couple of years, again, even in the absence of top line growth. And so corporate governance improvements, again, that you want to focus on is if they have cross shareholdings, are they going to unwind the cross shareholdings? Do they have an independent board of directors? Remember, when Abe came onto the scene and he wanted Japan to be more competitive across the whole military industrial complex, he actually told companies that they needed to hit these ROE targets. You'll remember they had an index that they were going to delist from if they didn't get to an ROE of at least 5, right? So these companies, you want to look for all of the things that he was focused on. And if I could just take a step back and say one thing about corporate governance quickly, which is that this is the same behavior that drove Japan to a bubble in the late 80s, right? Which is a very consensus-driven behavior in that market, which created a challenge, which of course was the bubble that the country's still recovering from, actually can be harnessed in a really positive way. And that's what you've seen in corporate governance. The progress that Japan has made on the corporate governance front is effectively unrivaled in any developed or emerging market in the world to have made the progress they did over the last 5 years. So I talked about unwinding cross holdings. I've talked about executive compensation. Just on the independent board of directors, they've gone from the number of companies that had at least 2 independent board of directors has gone from below 10% to over 90% in the last 5 years. So these companies get on board quickly with that behavior. And that's absolutely part of the tailwind to the story here. On the front about women going to work, as I mentioned, female labor force participation is way up. That's good for GDP. One of the things that's driven that the most, that actually we've invested in beneficiaries of this over time, is opening up childcare spots. So if you follow female labor force participation rate on a chart, if you chart that, it goes up almost in step with the number of daycare spots available for children, which is an investable space in Japan.
And we've spoken a little bit about the reasons that people have been hesitant to get into Japan. But does this message cut through? I mean, when you come across clients who have a choice of anywhere in the world to park their money, frankly, do you feel like you're still having to make the argument for Japan?
Yeah, Japan doesn't sell itself. We'll say that. There's more interesting themes that are out there that people are more excited about. So it does take more work to get people interested in this part of the world. A lot of times they think they have sufficient exposure to it through their global equity portfolio. Or if we talk about the growth themes, they think they have access to that in the US, or they're worried about the currency movement. So those list of things I said at the outset, and I have empathy for that. We understand that, investors are concerned about. But honestly, I really do think that investors need to diversify away from the current opportunity set. The U.S. has had an unbelievable 12-year run. Do I think it's going to be the dominant market over the next 12 years? Probably not, because the world doesn't work that way. And so even for our U.S. investors, I know this is a European audience, but even for our U.S. investors, they're actually, we're working with them to diversify away from the U.S. to go large cap in particular, to go down and cap and hunt for opportunities in other parts of the world. And we are getting some traction on that because of the valuations. Overall, just to put it in context for people, the whole US market's at a 4.4 price to book, and Japan's at, I think, 1.4. So
Yeah.
again, like there's not a lot of places left in the world where you can get this amount of quality, this secular growth, this improvement in corporate governance, and be able to do it at attractive valuations. So I would be selling US large cap and buying Japan here.
Right, right. And what kind of reception does this strategy get in Europe? As you mentioned, we've got a largely, European audience. Does it make sense for European clients?
Yeah, I do think that, first of all, there's from an implementation perspective in the fund world, which I know a lot of people on this call are operating in, there are some great options in the CCAV umbrella for Japan dedicated managers,
Yeah.
much more so than the US. So I do think that we have actually gotten a lot of traction, and most of our take up has been from our European clients through our CCAV funds. And I think we've been able to convince Europeans to also diversify into other parts of the developed world, number one, but number two, in active management. And if you believe in active management, there's some great managers in this place in the CCAV. So we have had success there. I'd say Europeans are further along the journey in adopting Japan and more familiar with international markets and international everything than Americans. I can say that as a dual citizen of the UK and the US. And the Americans are kind of earlier, both retail and institutional. So yeah, we've had pretty good traction in Europe, and a
Yeah.
lot of options to implement for Europeans.
And obviously, never make predictions about the future, but what do you think is the path that this market's going to take over the next 5 years? What kind of opportunities are you looking out for?
Yeah, I mean, I over the next 5 years, we could be wrong, and I should say I'm going to give a prediction, but I also want to give the footnote that I have no proven ability on calling equity markets. A great track record on picking stocks, but not on equity markets. But since you asked, I won't shy from sharing my opinion. I think it's very probable. We saw Japanese markets keep pace with U.S. markets in 2020 in aggregate, which was pretty good. I think it is possible because of course the valuation starting points more attractive, that we could have Japanese outperformance versus US and other developed markets. I would say that's more likely than not. And then within it, I think we have, especially in the large cap space, much better alpha story. Less covered companies, foreigners, just as you for this conversation, just starting to get interested in it. So you're going to have more foreign inflow coming in. It's mostly domestically held, which creates more inefficiency. I think it could be a much better beta story than other developed markets over the next 5 years. Double-digit plus type returns compounded. And then, you should be able to extract a 5 to 10% alpha if you run a highly concentrated portfolio. So I do think the return opportunity here is tremendous.
And what kind of difference would that make if Japan really does outperform the US? That would be just quite the turnaround, right? It would be, and it's funny the things that shift people's thinking. So last year, as I mentioned, it was Warren Buffett taking stakes in Japanese brokerages. That really did make a lot of fund managers that I speak to sit up and think, I haven't thought about doing this. What's been the impact of that for you?
Yeah, so that obviously made a difference. I'd also point out that a lot of the private equity companies, because we have a huge amount of dry powder, as everybody knows, in private equity. If we have a lot of perpetual privates, companies that can stay private a lot longer because of the capital around. They are also looking for underbid opportunities, and the U.S. has been combed over quite a bit in public and private markets, and so you're seeing a lot of the big private equity firms and some of the smaller ones getting much more active in Japan too. So there's going to be a lot of M&A activity. We're obviously invested in companies that we think will be the beneficiaries of that, but we should expect to see more involvement for the Warren Buffetts of the world, but we should also expect to see more Buffett, private long-term capital coming to Japan and unlocking value in the public equity markets. And so that's another interesting dynamic that could be quite relevant over the next 5 years.
And what's the biggest kind of competition, if you like? If people are going to, weigh up their opportunities in Asia, say, what is it that you butt up against in terms of competition?
Yeah, so they're kind of the only game in town, other of
Yeah.
size for developed markets, but obviously people are looking to Asia for emerging market exposure too.
Yeah.
I would say that in that region, our favorite countries, if we put our global lens on and include both emerging and developed markets, some of our favorite companies for both a beta opportunity but also an alpha opportunity would be Japan and also the China A-share market. So those are the two that I think are
Yeah.
competing the most in that region for investor attention. Very different markets, very obviously very different list unities in both of them, but played the right way and invested in the right way, I think both present a lot of market upside and also substantial alpha potential. And so people looking for alpha, sorry, I didn't mean to speak over you, Katie.
No, not at all. I was just thinking that, the inflows into China over the past sort of 12 to 18 months have just been extraordinary. Does that actually just help create an ecosystem of foreign inflows into Asia writ large?
Yeah, I think I think it's good for people to be looking to Asia for other destinations of capital and for them to be interested in both developed and emerging exposure. The China A-share market's a very different story again from Japan, but they should both be beneficiaries of foreign inflows. In the case of China, it's literally that there's been controls, obviously, to foreigners accessing the A-share market. Those controls have been lifted. The government's actually interested in getting more institutional investors and more foreign capital into the Chinese market to help, quote unquote, institutionalize it and mute volatility and get out of the retail dynamic. And so they're very, in theory, they should be friendly. Lots could change. We probably don't have time to go into the whole Sino-US-Japan dynamic, but a lot could change. But right now they're on a trajectory of opening up for foreign capital. And that's going to bring a lot of foreign inflow into that market, which will be helpful to investors. In the case of Japan, it's mostly already open to foreigners. There's obviously some limits, but we're broadly open to foreigners. Yeah. But it's about foreigners taking a revisit of that market because of looking at it through this new lens. To your very good questions at the beginning, that it's not just value, that it's not just mean reverting, that there are some great companies here. And so you're slowly starting to see foreigners commit to that market, not as a trade, but as an investment opportunity. And foreigners haven't committed to Japan as a true compounding investment opportunity, maybe ever, but certainly in several decades, it hasn't been viewed that way. So that's going to be a very, different experience.
Yeah, definitely. Now, you mentioned China-US relations, and that's a whole other conference session. But there's a lot to talk about there. But how much does geopolitics affect Japan as an investment destination?
It's important. It's important, and it obviously has its own dynamics with China to think through. And so I think if you look at the risks there, it wants to it needs, it doesn't just want, it really needs China as a trade partner.
Yeah.
As I believe actually the US does too, putting the rhetoric aside, but it also wants to check its political influence. So it's very similar to the dance that the US is going to have to do with China.
Oh, I think I can hear a smaller member of the Koch family chiming in. Listen,
I'm on the Japan. I should be in Japan because we were talking about our families at the outset. I have 4 kids, 6 and under. If I was in Japan, I'd be very much changing the demographics there for the better. But, to wrap up that point, I think that it is a risk. So if you think about the risks, the geopolitical situation is definitely a risk. And it's the same risk that we have Sino Japan versus Sino US. And so it's definitely something that one should consider. But Japan is more exposed, arguably, to the China trade issue than the US is. So you're right. It's a risk and people should think about it when investing there. We think it's more than offset by valuations and the opportunity, but it's certainly a risk.
But the changeover in domestic policies seems very much to have been taken, in the market stride.
Yeah, that's true. And the other risk people would care about is like, will Abe's successor, Suga, will he continue the same policies? Because they've been very helpful, obviously, to unlocking value and improving return on equity in Japan. It's our view and the view of our dedicated team on the ground there that he's very much going to continue on that route. And so people should feel good about the continuation of domestic policies that have been helpful to capital markets there, in our view.
Yeah. Katie, we're going to have to leave it there. Well done to your family for staying relatively stum throughout. It's been a really interesting conversation. Thank you.
Thank you, Katie. And it was great to talk to another Katie. And good luck to everybody out there. Stay healthy. Bye-bye.
Thank you.